Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 26th of January. I'm Daniel Lam, your host for the podcast. Continuing from last Thursday, when we spoke about Indian equities, I would like to take a look at another area that we like in our 2026 annual outlook, EM debt. We're overweight emerging market bonds, denominated in both US dollar and local currency, expecting them to outperform other major bond asset classes. Now, despite the wobbles that we've seen in global markets over the past week, EM debt funds continue to attract robust inflows. Weakness in US dollar helped offset some of the risk of a further escalation in global trade-related uncertainties. Now, amongst EM debt, local currency funds recorded exceptionally strong inflows at $1.5 billion last week, the largest weekly inflows since January 2018. Meanwhile, EM hard currency debt funds also attracted slightly stronger demand. Now, global bonds are increasingly characterized by tight credit spreads, i.e., elevated valuation relative to US government bonds. But EM bonds stand out in three ways. First of all, they have attractive credit quality, and that's visible in improving fiscal fundamentals, a higher yield relative to DM bonds, and diversification via the FX component towards non-dollar bonds. Local currency bonds also provide exposure to rate cut cycles and falling yields in many EM local markets. Now, we're not negative on DM bonds per se. Individual defaults tend to capture news headlines, but aggregate default rates remain low, keeping credit spreads tight. However, we continue to like taking risky DM asset exposure via equities, given the upside is relatively less capped versus credit. As the market moves past the initial knee-jerk reaction to the Greenland issues and the tension between the US and Europe, the US 10-year government bond yield should gradually normalize and go lower. That can also help EM dollar bonds. We expect the US 10-year bond yield to gradually ease to 3.75 to 4% over 6 to 12 months as we continue to expect Trump to support risky assets going into the midterm elections and our expectation of 3 Fed rate cuts in 2026. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.